One handle, two platforms. That handle is the only fingerprint they can't forge. If anyone DMs you for money, wallet addresses, VIP access, or signals, it's a scam. I sell nothing, ever. Now type setup in the comments if you're actually locked in, because this is one of those moments where the market's telling you in plain English that the next move in silver won't be decided by a chart pattern. It'll be decided by policy shock, war logistics, and dollar liquidity. Trump's new 10% tariff, Iran war escalation, a strong dollar, and silver sitting around $83 like it's been left for dead. Stop. This matters, because $83 isn't the story. $83 is the stress point. The point where the market proves whether the selling was A, a real breakdown in demand, or B, a forced liquidation flush, where paper hands get washed out and the real bid is waiting. And if you understand that difference, you stop getting farmed by silver. Because silver doesn't punish you for being wrong. Silver punishes you for being early with leverage and late with emotion. Now, quick transparency. Your Reuters link wouldn't load directly for me, so I extracted Reuters reporting from a Reuters syndicated copy. Reuters reported Trump moved to replace tariffs struck down by the Supreme Court with a temporary 10% global import duty for 150 days and ordered new investigations under other laws that could enable broader tariffs later. Investing.com. That one sentence is the policy shock. Temporary, but paired with investigations, meaning uncertainty isn't ending, it's reloading. Now here's how we're going to build this script, the OG way, for maximum retention. In the first minute, I'm going to show you why the 10% tariff is not about trade, it's about liquidity. Then I'm going to show you why war doesn't guarantee silver up. War can actually push silver down temporarily and still set up a bigger move later. Then I'm going to show you why the strong dollar is the weapon that pins silver down. Then I'll give you a binary map, 2 scenarios, and a 48-hour watch list you can screenshot mentally. Because if you're here for hopium, you're on the wrong channel. We map. We don't pray. Let's start with the tariff. Most people hear 10% tariff and think it's a political talking point. Markets hear it and think risk premium, because tariffs change the inflation growth mix, and that mix is what drives everything you care about: the dollar, yields, stocks, and eventually metals. Tariffs can be inflationary because they raise the landed cost of imports. Tariffs can be growth negative because they reduce trade efficiency and raise uncertainty. That combination is the worst possible cocktail for risk assets: higher costs, slower growth, more uncertainty. And when the market sees that cocktail, the first instinct is not buy silver. The first instinct is de-risk. Now notice how Reuters framed it. 10% global duty for 150 days plus investigations that could enable more. Investing.com. That plus investigations clause is huge because it tells the market the 10% is the floor, not necessarily the ceiling. It tells the market trade policy is unstable again, and when trade policy is unstable, global capital does something predictable. It goes to liquidity. It goes to the settlement currency. It goes to the dollar. Now layer the war. War isn't a headline. War is a logistics engine that changes prices through scarcity, insurance, and supply chain risk. When Iran war escalation threatens shipping lanes and energy choke points, oil reprices fast. Oil repricing is inflation repricing. Inflation repricing changes yields and the dollar. And that's why war doesn't automatically mean silver up. War can mean silver down first because the dollar and yields can spike and silver is high beta. Now stop. Pattern break. Oil is necessity. Gold is trust. Silver is leverage. Dollars are collateral. In a stress regime, collateral moves first. That's why the dollar is the weapon. Not because someone flips a secret switch, because everyone in the world needs dollars to settle energy contracts, pay shipping, and meet margin. So when tariffs hit and war hits, the world hoards dollars. And a strong dollar tightens the noose on silver, because silver is dollar-priced, higher beta, and leveraged in paper markets. So you can get this impossible situation: oil ripping, gold firm, silver dumping, same day, same war, different mechanisms. Now your title says silver at $83 is the setup. So let's define setup the right way. Setup does not mean guaranteed upside tomorrow. Setup means conditions exist for a regime flip if a key constraint relaxes, and the key constraint is the dollar. Silver cannot lead while the dollar is tightening the noose. Silver leads when the dollar stops tightening. So silver at $83 becomes a setup only if one thing happens: the dollar blinks. Now let me explain why $83 specifically matters. Because in these regimes, silver doesn't drift down gently. It flushes down to where sellers get exhausted. That exhaustion zone is not where you feel comfortable. It's where you feel disgusted. It's where you want to quit. That's how silver works. So $83 is the emotional low zone. And in many markets, emotional lows coincide with structural zones where real buyers step in, if the macro regime is still supportive. Now, what's supportive in your title? War risk, energy risk, tariff uncertainty. Those support the hard asset narrative. But what's suppressing silver short term? The dollar. So the setup is this: supportive macro, suppressive liquidity. That creates compression, and compression creates snap moves. Now stop. Pattern break. Silver isn't dead at 83 hours. Silver is compressed at 83. Compressed springs don't drift. They snap, but they only snap when the constraint loosens. Now let's talk about the war secret banks use today, because your audience always wants a villain. Here's the truth. Banks didn't need a secret meeting. They use structure. Institutional risk systems behave predictably in a stress tape. Here's the playbook. Buy the pure hedge first, that's gold. Raise liquidity second, that's dollars. Cut high beta third, that's silver, especially paper silver. That's why silver gets sold even in a bullish macro narrative, because the first wave is about survival, not upside. Now, this is where most YouTube channels lose credibility. They claim silver dumping is proof of manipulation. No, silver dumping is proof of leverage and liquidity stress. It's proof that someone had to raise cash. It's proof that risk desks tightened. That's plumbing. Now, how do you tell if this is a flush or a break? One signal. Rebound speed, not bounce size. Speed. If silver hits $83 and rebounds fast, it was mechanical selling and buyers were waiting. If silver hits $83 and bleeds slowly, demand isn't committed and the unwind isn't done. That's the adult framework. Now let's tie this back to tariffs again, because tariffs matter more than people realize. Tariffs can push inflation higher while also pushing growth lower. If inflation rises, central banks can't cut easily. If growth slows, risk assets wobble. That combination increases volatility. Volatility increases margin calls. Margin calls force liquidation. That's what pressures silver. So ironically, the same macro regime that could support silver long-term can suppress silver short-term through liquidity stress. That's why silver is so psychologically difficult. It punishes you before it rewards you. Now stop. Pattern break again. Gold rewards fear. Silver charges a toll for fear. That toll is volatility. Now we're going to do the binary scenario analysis, because in a regime like this, you don't make one prediction. You map scenarios and watch which one the market confirms. Scenario A, dollar squeeze continues. Tariff uncertainty stays alive because Reuters framed the 10% duty as temporary and paired it with investigations that could enable more tariffs. Investing.com. War risk keeps oil elevated and inflation fears alive. Global investors hoard dollars for settlement and safety. In this scenario, gold can stay strong. Oil can stay elevated. Silver stays ugly and choppy. Because the dollar keeps tightening the noose, this is the scenario that makes silver look broken. But it's not broken, it's suppressed by liquidity. Scenario B, dollar blinks first. Tariff shock gets priced and stops escalating. Markets get a liquidity release, maybe through policy signals, maybe through de-escalation, maybe through positioning. War risk persists enough to keep oil elevated and keep hard assets relevant, but the dollar stops rising. In this scenario, gold stays strong, oil stays strong, and silver flips from collateral victim to scarcity bid. That's when $83 becomes the setup, because the constraint relaxes and silver's spring snaps. Now you might be thinking, okay, but what does the flip look like in real time? Here it is. The flip begins when silver stops underperforming gold and starts outperforming. On up days, silver gains more than gold. On down days, silver refuses to underperform. That's how you see the regime transition. Now I'm going to give you the 48-hour watch list. This is the part your audience will rewatch. Dollar direction. If the dollar is still rising, silver is still under pressure. If the dollar stalls while oil remains elevated, the constraint is loosening. Oil hold. If oil holds a premium, inflation fear stays alive and hard assets remain relevant. If oil collapses back, stress is fading and silver leans into industrial recession fear. Silver rebound speed around $82-$85. This is the battlefield zone. Fast rebound, Hawks flush, Hawks setup, slow bleed, Hawks break, Docks caution, gold versus silver relationship, gold up with silver down, Hawk gold first fear still in control, gold steady with silver outperforming, sucker flip is starting, tariff escalation headlines. If the market starts pricing 10% was just the beginning, the dollar bid stays alive longer. Reuters framed it as temporary with investigations, so this is not a closed book. Investing.com. Now here's the psychological part you need to say out loud because it's what keeps retention high. Silver doesn't bottom when you feel smart. Silver bottoms when you feel embarrassed. When you say, why did I ever touch this? That's why the setup exists at $83, because $83 is where the crowd is emotionally exhausted. And emotional exhaustion is what ends selling if the macro bid is still alive. Now we close the loop. So what's the truth they're hiding here? They're not hiding the bull case. They're hiding the path. They show you the long-term chart. They don't show you the psychological war in the middle, where 6% down days happen while your thesis is still intact. Because if you lived through the middle, you wouldn't believe the end was possible. That's silver. Now, I'm going to end the OG way. 3 takeaways and a cliffhanger. Takeaway 1. Reuters reported Trump imposed a temporary 10% global import duty for 150 days after earlier tariffs were struck down, and ordered investigations that could enable broader tariffs later, meaning trade uncertainty is not ending, it's reloading. Investing.com. Takeaway 2. Tariff uncertainty plus war escalation creates a toxic mix of inflation fear, growth fear, and liquidity hoarding, supportive for gold and oil, but often suppressive for silver in the first wave because silver is high beta and gets sold for collateral. Takeaway 3. Silver at $83 is the setup only if the dollar blinks, because the dollar is the settlement and margin weapon that pins silver down first. When it loosens, silver doesn't drift, it snaps. Cliffhanger. If the dollar stalls and silver bounces fast off the $82, $85 zone, the flush is over and the next leg begins. And if it doesn't, if bounces get weaker and the dollar keeps tightening, the cleanse isn't done. This isn't financial advice, this is financial warfare education.